Imagine walking through a luxury kitchen showroom in California. Gleaming countertops, sleek finishes, top-tier materials. But behind those stunning surfaces lies a company you may have never heard of. Pokarna Ltd, a Hyderabad-based Indian manufacturing company, founded in 1991, that's become a global force in high-end stone surfaces. Pokarna's business is engineered stone, specifically quartz, and natural granite sourced from its own quarries. It operates through two key divisions. 1. Natural Granite. Pokarna owns captive granite quarries, meaning it controls the stone from the ground to the final slab. This granite is used in monuments, flooring, and large structural projects, both in India and overseas. Sold under Pokarna's own brand, it's a stable business, not hypergrowth, but consistent and cash-generating. 2. Engineered quartz surfaces. This is where Pokarna shines, using advanced Bretonstone registered trademark technology, a patented process used by global luxury brands. Pokarna creates quartz slabs for kitchen countertops, vanity tops, and commercial interiors. These are exported to the United States and other global markets. But here's what's different about Pokarna's model. It doesn't sell under its own consumer brand. Instead, it follows an OEM model, meaning it manufactures for foreign brands who repackage and sell the product under their own names. For example, a quartz slab made by Pokarna in India could end up in a US kitchen, branded by a large American retailer. This B2B export model has major advantages. Pokarna doesn't spend on advertising. It doesn't run sales campaigns. It focuses purely on scale, efficiency, and delivery. That's why over 75% of Pokarna's total revenue comes from exports. And over 80% of its revenue now comes from the quartz business. The company has invested in a fully automated quartz manufacturing plant, one of the most advanced in India. With robotic production lines and precision control, this plant allows higher productivity, zero manual error, uniform product quality. This has transformed Pokarna into a technology-led manufacturer with built-in operating leverage. From 2016 to 2021, Pokarna was in a heavy investment phase, setting up the new facility. But now, it's in the monetization phase, scaling volumes, expanding exports, and unlocking returns on that investment. So what's the investor insight here? Pokarna isn't building a consumer brand. It's building a quiet compounder. A business that grows behind the scenes with a lean model, tech edge, and export scale. You may not see its name on a retail label, but chances are you've already seen its work in a luxury home or hotel. This is Pokarna Ltd, a stone surfaces company that doesn't chase the spotlight, but delivers quietly, precisely, and profitably. Coming up next, Scene 2, Pokarna's 10-year financial performance, from Rs 150 crore to over Rs 900 crore. Let's explore the numbers behind the narrative. Let's break down a decade of Pokarna's financial journey, so even a first-time investor can understand what these numbers truly reveal. We'll start with the simplest but most powerful number, sales, also called revenue. This is the total value of granite and quartz that Pokarna sold each year. Think of it as the top line, because it sits at the top of every profit and loss statement. In FY16, Pokarna sold products worth Rs 391 crore. But over the next few years, sales remained almost stagnant. Rs 365 crore in FY17, Rs 335 crore in FY18. Even by FY20, it was just Rs 393 crore. So what happened? Well, during these years, Pokarna had limited production capacity. They hadn't yet launched their advanced quartz facility. But then comes a major shift. In FY21, despite COVID challenges, they held ground with Rs 295 crore in sales. Then in FY22, boom, sales more than double to Rs 650 crore. By FY23, revenue rises again to Rs 725 crore. FY24 sees a mild correction to Rs 687 crore, and FY25, trailing 12 months, rockets to Rs 930 crore. That's nearly a 2.5x jump from the flat years. This growth isn't accidental, it's the result of strategic investments. The new generation quartz plant, built with world-class automation, allowed Pokarna to ramp up production without proportionally increasing costs. Now, sales tell us how much is being sold, but what about how efficiently it's being sold? That's where operating profit and operating profit margin, or OPM, come in. Operating profit is what's left after covering direct business costs like raw materials, electricity, wages, and admin expenses. It's like asking, how much profit do we make before paying the bank and the government? In FY16, Pokarna made Rs 134 crore in operating profit, an OPM of 34.4%. In FY25, that operating profit is Rs 326 crore, with an OPM of 35.0%. In fact, across 10 years, Pokarna's OPM has consistently hovered between 28% and 35%. That's elite for a manufacturing exporter. It tells us one thing loud and clear. Pokarna is extremely efficient. Its use of technology, captive granite quarries, and tight cost controls allow it to keep a large share of revenue as pure business profit. Now, let's move to the bottom line. Net profit after tax, or PAT. This is what's left after everything. Costs, interest on loans, taxes, has been paid. This is the money that actually builds reserves, pays dividends, and creates value for shareholders. In FY16, PAT was Rs 51 crore. In FY25, TTM, it stands at Rs 188 crore. That's more than 3.5 times in 10 years. And the CAGR, the average annual growth rate, is a healthy 15.3%. It means that even though sales were flat early on, Pokarna still managed to compound profits by improving margins and scaling efficiently. But how much of every rupee sold actually becomes profit? That's the job of net profit margin, or NPM. NPM is calculated by dividing PAT by sales. In FY16, Pokarna had an NPM of 13.1%, which is already solid. But in FY25, it hit 20.2%. In simple terms, Pokarna now earns Rs 20 of pure profit for every Rs 100 of revenue. That's considered outstanding, especially for a company that exports physical products. Many firms operate on 5–10% margins. Pokarna does double that, and it gets better. Even during tough inflation years like FY23, when margins dipped, Pokarna bounced back strongly by FY24 and FY25. That's the hallmark of a resilient, high-quality business. Let's recap. Sales, Rs 930 crore, growing with clear scalability. OPM, 35%, among the highest in the industry. PAT, Rs 188 crore, compounding efficiently. NPM, 20.2%, converting revenue into real shareholder value. For a new investor, the takeaway is simple. Pokarna isn't chasing vanity metrics. It's showing real profits with real cash from real exports, and doing so with consistency, not luck. As an investor, you've probably heard this before. Revenue is vanity, profit is sanity, but cash is reality. In this section, we go beyond profits to answer a deeper question. Is Pokarna actually generating cash, or is all the profit just on paper? Let's dive into Pokarna's cash flow performance, with a focus on three critical pieces. Cash flow from operations, also called CFO, capital expenditure, or CAPEX, free cash flow, what's truly left over. First, cash flow from operating activities. This measures how much actual cash Pokarna brings in from its day-to-day business, after accounting for working capital changes and non-cash expenses. Think of it this way. Profits might look good, but if the company is not collecting money from customers or is stuck with unsold inventory, it won't survive long. Let's look at the numbers. FY16, Rs 105 crore, FY20, a huge Rs 379 crore, FY23, Rs 135, 7 crore, FY25, TTM, Rs 191, 3 crore. Most years, CFO closely tracks or exceeds net profit, which is excellent. The spike in FY20, that was due to inventory liquidation and customer advances. The dip in FY22, a temporary strain during the new Quartz plant ramp-up. But FY24 and FY25 show a clear recovery, confirming Pokarna's operations are now cash efficient. Second, capital expenditure, or CAPEX. This is how much Pokarna spends on expanding factories, buying new machines, or upgrading facilities. Think of CAPEX as long-term investment. It doesn't show up as an immediate expense, but it drains cash up front. Pokarna's CAPEX trend. FY20, Rs 408 crore, The peak capex year for the new Quartz plant, FY21 to FY24, slowed down as the company focused on stabilizing operations. FY25 TTM, Rs 103, 6 crore, showing signs of ongoing upgrades. Key point here, the heavy investment phase is largely behind. Pokarna is now in a monetization phase, not a build-out phase. Third, free cash flow, or FCF. This is the most important number for long-term investors. FCF equals CFO capex. In simple words, this is what's left over after running the business and investing for the future. If free cash flow is positive and consistent, that's the mark of a self-sustaining shareholder-friendly company. Let's look at the FCF trend. FY17 Rs 90, 2 CR FY18 Rs 47, 1 CR FY20 negative Rs 29. 3 CR due to massive capex, FY23, Rs 120, 8 CR FY24, Rs 104, 7 CR FY25, TTM, Rs 87, 7 CR. After years of investment, Pokarna now consistently generates Rs 120 crore in surplus cash every year, and it does this without raising new debt or diluting shareholders. Investor takeaway. Pokarna has completed its high investment cycle, proved it can turn profits into real hard cash, and is now funding growth from internal cash, not loans. That makes it a rare gem in the manufacturing sector. In fact, this transition from capex heavy to cash rich is the single biggest green flag for any long-term investor. The next time you look at a company's profit, ask, but where's the cash? With Pokarna, the answer is loud and clear. It's right here and it's real. You've seen that Pokarna is growing. But here's the real investor question. Can it continue to grow, using its own cash, without borrowing money or issuing new shares? That's exactly what the self-sustainable growth rate, or SSGR, tells us. Let's break it down in simple words. SSGR is the maximum rate at which a company can grow, purely by reinvesting its own profits, without taking new loans or diluting shareholder equity. If a company grows above its SSGR, it must raise money from outside. If it grows below SSGR, it can reinvest and still have cash left over, which is ideal. So what influences SSGR? Operating profit margins, tax rate, capex intensity, working capital requirements, efficiency of cash reinvestment. Now let's look at Pokarna's actual SSGR trend. SSGR percentage from FY19 to FY25 TTM. FY19, 15.8%. FY20, 14.7%, FY21, 11.3%, FY22, 7.1%, FY23, 3.6%, FY24, 4.8%, FY25, 8.8%. So what's the story here? From FY19 to FY21, Pokarna was investing heavily, setting up the new Quartz plant. That's why SSGR declined. By FY22 and FY23, the company was still absorbing working capital and capex pressure. SSGR hit a low of just 3.6%. But now, in FY25, SSGR has recovered to 8.8%. That's a key signal. Pokarna is exiting its capex-heavy phase and entering a self-sustaining phase. In other words, Pokarna can now fund around 9% growth annually, just from internal cash flows. If it tries to grow faster, say 15% or more, it may need to borrow more, which adds debt risk, or dilute equity, which hurts shareholder returns. So as investors, what should we monitor? Track whether future growth aligns with SSGR. If growth stays at or below 9%, that's sustainable. If it goes well above 10%, ask, where's the funding coming from? The sweet spot. Companies that grow just below or near SSGR tend to maintain low debt, protect shareholder equity, avoid cash burn. That's exactly where Pokarna is now. It has passed the capex stress test, cash flows are stabilizing, and SSGR is catching up with growth again. This is why SSGR matters, because growth without cash is dangerous. But growth that feeds on its own profits, now that is a compounding machine. Pokarna is entering that zone. So far, we've seen that Pokarna has strong sales, profits, and cash flows. But numbers only tell half the story. As investors, we also need to ask, how does Pokarna plan to grow, and can it defend that growth over time? That's where business strategy and competitive positioning come in. Let's start with Pokarna's core focus: quartz surfaces for the export market. Through its subsidiary PSL, Pokarna makes high-end quartz countertops that are sold to big-box retailers and kitchen manufacturers, especially in the US. But here's the twist: Pokarna doesn't sell under its own brand. Instead, it follows an OEM model, manufacturing for global brands like Lowe's or Home Depot, who then rebrand and resell. What's the benefit? Pokarna avoids marketing costs, gains fast access to retail shelves, and scales volumes quickly. The downside: less pricing power and no brand recall. But Pokarna has an ace up its sleeve, and that's technology. It's the only company in India licensed to use Bretonstone registered trademark technology, the global gold standard for quartz manufacturing. Globally, this tech is used by premium brands like Cambria, Silestone, and Caesarstone. So even though Pokarna operates from India, its products meet global luxury standards at Indian costs. That's a rare competitive moat. And it doesn't stop there. Pokarna's new quartz facility is fully automated, using robotic arms, ERP systems, and Industry 4.0 tools. This brings in two major advantages: lower manpower and errors, higher precision and customization. Result? A high operating leverage model, where every new sale adds more to profit than cost. On the other side, Pokarna's granite business adds stability. With captive quarries of exotic granite, it supplies both Indian and export markets under its own brand. Granite may not be high growth, but it's consistent and cash-generating, like a reliable old engine that keeps the business running smoothly. Altogether, Pokarna's strategy is very clear. Don't spend on branding. Spend on tech, automation, and global integration. As a result, it becomes a quiet compounder, growing margins without shouting in the market. But it's not risk-free. The company is still heavily dependent on the US market, and it lacks its own consumer-facing quartz brand. That means any slowdown in US housing or policy change could impact volumes. Still, Pokarna's position is enviable. Tech moat, cost moat, execution moat. It may not be building a brand, but it's building something deeper. A system that scales, earns, and sustains. And in long-term investing, that's the real brand value. A company can have great numbers, but if leadership lacks integrity, none of it matters. That's why, as long-term investors, we need to look beyond the balance sheet. In this section, we analyze who owns Pokarna, who runs it, and how do they treat minority shareholders like us. Let's start with promoter holding, a powerful indicator of alignment. Pokarna's promoters hold 56.7% of the company. That's more than half, which means the people running the business have real skin in the game. This level of ownership provides stability and reduces the risk of dilution, hostile takeovers, or strategic U-turns. And here's the good news. The promoter stake has remained stable over the years. No pledging, no dilution, no shady stake transfers. In today's small-cap world, that's rare and valuable. Now let's talk about institutional confidence. In FY25, FII holding rose from -3% to 6.6%. DII holding jumped from -9.8% to 15.2%. At the same time, public retail holding dropped to 21.5%. Why does this matter? Because when large funds increase their stake, it signals growing institutional conviction. These are the investors who have access to management calls, deep data models, and inside channel checks. If they're buying, it's worth noticing. Next, let's assess the management team and board governance. The previous leadership team successfully led the quartz expansion and operational ramp-up. Recently, the CEO of PESL resigned, which is something investors should track. But as of now, no signs of disruption or strategy shift. Pokarna's board includes independent directors, suggesting compliance with good governance norms. And now for one of the most overlooked metrics, capital discipline. Despite high capex over FY 2022, Pokarna took no excessive debt, issued no equity, and used internal cash for repayment. That's rare execution maturity in the mid-cap space. Dividend. Pokarna has paid a modest fixed Rs. 86 CR dividend for 10 straight years. Not much, but consistent. This tells us that management prefers retained earnings over payouts, aligning with a long-term compounding model. And here's the clincher. There are no audit flags, no promoter pledges, and no related party mischief. External auditors, Deloitte, have issued clean audit reports across all years. No unusual intercompany loans, no inflated capex, no unexplained losses. All of this points to one conclusion: Pokarna's governance is clean. Yes, we should track the upcoming CEO appointment at PSL. But overall, Pokarna ticks the boxes that matter most: promoter skin in the game, growing institutional trust, transparent board policies, financial prudence. In a world where governance risks often sink good companies, Pokarna gives us a breath of fresh air. As investors, that matters more than any quarterly profit. A company can grow fast, but if it's drowning in debt, that growth is dangerous. In this section, we explore whether Pokarna's growth is financially safe and sustainable, or if it comes with hidden risks. We'll assess 4 key metrics that every long-term investor must understand: total debt, cash reserves, interest coverage ratio, return on capital, ROCE and RO. Let's break each of them down. 1. Total debt. In FY16, Pokarna had Rs 272 crore in debt. Over time, debt rose, peaking at Rs 515 crore in FY22. Why? That was the year Pokarna completed its largest capex project, the fully automated Quartz plant. Since then, the company has steadily reduced debt. FY23, Rs 459 crore, FY24, Rs 401 crore, FY25, TTM, Rs 330 crore. That's a Rs 185 crore reduction in 3 years, a clear sign of internal cash generation and capital discipline. 1. Cash plus investments. Let's look at what Pokarna owns in liquid reserves. From FY16 to FY23, cash balances hovered around Rs 25, Rs 35 crore. But here's what changed. FY24, Rs 82, 9 crore, FY25, TTM, Rs 123, 3 crore. That's nearly a 4x jump in 2 years. It tells us Pokarna now has ample liquidity cushion, which it can use to repay debt, fund new expansion, or handle market slowdowns. Think of it like an emergency fund, and Pokarna's is well stocked. 1. Interest coverage ratio, ICR. This tells us how easily a company can pay interest from its operating profit. A ratio above 3 is considered healthy. In Pokarna's case, FY22 to FY24 range between 4x to 6x, FY25, TTM, more than 7x. That means Pokarna earns 7 times more than its interest costs. A very comfortable position. It shows no signs of financial stress or default risk. 1. ROCE and RO, return on capital employed and equity. These 2 metrics measure how efficiently Pokarna uses its capital to generate profit. ROE, return on equity. FY25, 27.4%. That means for every Rs 100 in equity, the company generates Rs 27 in profit. Fantastic. ROCE, return on capital employed. FY25, 23.2%. A strong signal that both debt and equity capital are being used efficiently. For context, many companies struggle to hit even 15% consistently. Pokarna exceeds that benchmark, even after a heavy capex cycle. Final verdict: Pokarna has reduced its debt without dilution, built a strong cash buffer, maintained excellent capital efficiency. These are not small wins. They're the foundation of sustainable wealth creation. Many companies grow and crash under the weight of bad financial structure. Pokarna, on the other hand, is showing that it can grow while strengthening its balance sheet. And in long-term investing, that's the ultimate credit profile. Growth with strength. Pokarna isn't a one-product company. It's a dual-engine business built on 2 complementary pillars: Granite, Quartz. But having products isn't enough. What matters more is capacity, and how efficiently that capacity is used. So let's take a deep look into what Pokarna makes, how much it can produce, and how well it's using those assets. First, the product mix. Granite division uses Pokarna's own captive quarries, processes exotic high-quality slabs sold under its own brand, both in India and abroad, stable, cash-generating and lower capex intensity. Quartz division, built around Pokarna-engineered stone-limited products used in luxury kitchens, countertops and commercial interiors. Exported to big-box retailers and OEM clients in the US and beyond. This is where the real growth engine lies. Second, quartz capacity. Pokarna operates 2 quartz plants, a legacy facility built around 2016, a new fully automated digital plant commissioned in FY21. Together, these plants can produce an estimated 1.4 to 1.6 lakh square meters of quartz surfaces per year, roughly Rs 650 to Rs 700 crore in revenue potential at full utilization. That's significant and scalable. Third, capacity utilization trends. Quartz utilization. FY22, FY23, still in ramp-up mode. Utilization likely 40-50%. FY24, FY25, rapid improvement. By FY25, utilization estimated at 60-70%. This is confirmed by growing sales, rising margins, and stable inventory levels. Pokarna is now entering the operational sweet spot, where fixed costs are covered and every extra unit sold increases profit. Granite utilization, steady at approximately 70-75%, acts as the company's stabilizer. Consistent cash flow, lower volatility. Think of it like this: quartz drives growth, granite cushions risk. Fourth, CapEx efficiency. Pokarna has executed a massive CapEx cycle over FY 2022, and now plants are up, machines are running, products are scaling, there are no deadweight assets. Every investment made is now producing output, revenue, and cash. For investors, that means one thing: the business is now in monetization mode, not expansion stress. Final takeaways. Pokarna's product mix is balanced between high-growth quartz and steady granite. Capacity is ramping up smoothly, with room still left to scale. No idle assets, no overspending. Most companies struggle during CapEx transitions. Pokarna, it handled it with precision and now enjoys strong utilization, rising margins, and clean scalability. In manufacturing, that's the trifecta: product, plant, profit. Pokarna has all three in motion. If financial statements show the what, working capital shows the how. How fast does cash move through Pokarna's operations, and how efficiently does it convert stone into money in the bank? In this scene, we focus on 5 key indicators that reveal Pokarna's operating muscle: receivable days, inventory days, payable days, cash conversion cycle, trend insights. Let's decode what the data really says. Receivable days. This tells us how long Pokarna takes to collect money after making a sale. Fiscal year receivable days. FY17, 72.5 days. FY20, 47.4 days. FY23, 63.6 days. FY25, 59.9 days. From FY17 to FY20, receivables improved, collections got faster. But from FY21 to FY23, receivables rose again, possibly due to growth in exports. In FY25, it dropped slightly, suggesting credit discipline is returning. Inventory days. This tells us how long products remain unsold in stock. Fiscal year, inventory days, FY17, 93.2 days. FY20, 88.0 days. FY23, 92.1 days. FY25, 62.9 days. FY25 marks a massive improvement. Inventory is moving 30% faster than FY23. That's a clear sign of better demand planning and operational agility. Payable days. This is how long Pokarna takes to pay suppliers. More days equal sign better liquidity. Fiscal year, payable days. FY17, 134 days. FY20, 102 days. FY23, 71 days. FY25, 105 days. In FY23, payable days dropped, increasing working capital pressure. But by FY25, supplier terms improved again, pushing payables up to 105 days. Cash conversion cycle. CCC equal sign receivable days plus inventory days, payable days. The lower the CCC, the faster the cash comes back. Fiscal year, CCC days. FY17, 31.7 days. FY20, 33.4 days. FY23, 84.7 days. FY25, 17.8 days. That's the headline. CCC has fallen from 84.7 days in FY23 to just 17.8 days in FY25. Pokarna is now converting working capital to cash 5x faster than it was just 2 years ago. Final insights from research interpretation. FY17, FY20. Pokarna enjoyed stable cash-light operations. CCC hovered around 30-45 days. FY21, FY22. CCC turned negative due to long supplier credit terms, a short-term benefit. FY23, CCC spiked to 85 days due to growing receivables and falling payables. FY25, CCC has normalized to 17.8 days, showing strong operational rebound. Operating efficiency isn't just about cutting costs. It's about freeing up cash without hurting growth. Pokarna's latest numbers tell us loud and clear. Inventory is under control. Receivables are stabilizing. Supplier terms are healthy. Cash is cycling faster. This is what makes Pokarna efficient and cash smart. In the world of manufacturing, that's not just a win, it's an edge. Every investor loves a good growth story, but great investors also ask, what can go wrong? In this scene, we cover the strategic risks and red flags highlighted in Pokarna's research report. These are not speculation. These are the actual risk disclosures and concerns flagged in the report. Let's go one by one. 1. High export concentration. U.S. dependency. Pokarna's Quartz division exports the bulk of its output, and a large share of that goes to the United States market. The U.S. housing and construction sector has been under pressure in recent years due to high interest rates and slowing demand. The report notes, any prolonged slowdown in U.S. housing demand or macro conditions will directly impact Pokarna's sales volumes. This is a real risk, not yet visible in numbers but structurally important. If the US weakens further, Pokarna's Quartz growth engine could lose steam. 2. OEM business model. No brand premium. Pokarna exports quartz largely under an OEM model, meaning it manufactures for foreign brands but does not sell under its own label. The benefit? Faster scale. The risk? Pokarna lacks pricing power, has low brand recall, and may face margin pressure if buyers negotiate aggressively. The report clearly says, the company does not have control over the end customer brand experience or positioning. That's a structural limitation in the business model, even if it's efficient. 3. Customer concentration risk. Another key risk is that a significant portion of Quartz revenue comes from a few large customers. The report mentions that customer concentration remains high in the US retail OEM space. What this means? Losing even one major buyer could dent volumes, renegotiated contracts could impact margins. While no names are disclosed, the dependency is flagged explicitly, making this a serious watchpoint. 4. Granite business. Slow growth segment. Pokarna's Granite business is stable, but not a growth driver. The report notes, Granite revenues have remained range-bound for years, with little margin expansion or scalability. That means, Granite adds stability, but it doesn't contribute meaningfully to growth, and has lower ROCE. Investors betting on explosive growth must look beyond Granite. It's not where the future lies. 5. Raw material and input cost volatility. Pokarna's Quartz business depends on imported resins and pigments, whose prices can fluctuate. The report highlights, there's risk of margin volatility due to raw material price movements, especially resin and pigments sourced globally. While the company maintains stable margins for now, any global supply chain disruption could hurt profitability, especially since it doesn't control input sources. Summary. Real risks to monitor. The research report flags these 5 core risk zones. Risk area status. US market dependence. High risk OEM. No brand structural limitation. Customer concentration. Not diversified. Granite growth. Low potential input cost volatility. Margin. Risk. Pokarna is strong, but not invincible. And as intelligent investors, we must track these risks, not ignore them. Because the best investments are not those without flaws. They're the ones where the strengths clearly outweigh the risks, and those risks are known, not hidden. And that's what the research report has helped us uncover. The full picture, with eyes wide open. At this point, we've explored Pokarna's sales, profits, efficiency, and risks. But the final question remains, is the stock priced fairly, or has the market already factored in the upside? In this final scene, we break down Pokarna's valuation, using numbers and insights only from the official research report. Let's start with the key metric, price-to-earnings ratio. The PE ratio compares the stock's price to its earnings. Higher PE means the market expects stronger future growth. From the report, year FY22, price 412 rupees, EPS 21.5 rupees, PE 19.2x, FY23, price 343 rupees, EPS 24.4 rupees, PE 14.0x, FY24, price 484 rupees, EPS 29.6 rupees, PE 16.4x. FY25 TTM, price 571 rupees, EPS 31.6 rupees, PE 18.1x. Pokarna is currently trading at a PE of 18.1x, based on trailing 12-month earnings. This is higher than last year's 14x, showing that investor confidence has increased. But it's still below the FY22 peak of 19.2x, suggesting room for re-rating if performance sustains. The research report does not directly compare Pokarna's valuation to peers, but it does provide a 4-year historical lens. The 4-year average PE FY22 FY25 is approximately 17x. Current valuation of 18.1x is slightly above average, but not overheated. Report insight. Valuation appears reasonable considering improving asset turns, margins, and cash flow. The report justifies the valuation based on 3 factual improvements. Fixed asset turnover, up from 0.73x FY21 to 1.27x FY25. Cash conversion cycle, improved from 85 days FY23 to 18 days FY25. Debt reduction, from 515 crores to 330 crores without equity dilution. These improvements suggest that the company has exited the capex phase and is now entering a free cash flow compounding phase. Important to note, the report does not provide a specific target price, upside potential, or analyst rating. This scene is purely factual. No speculative pricing or price targets are included. At a current PE of 18.1x, Pokarna is being valued for what it is, a focused quartz exporter with improving operational performance, low debt, strong margins, and rising free cash. The market has acknowledged that, but not fully priced it in. This valuation doesn't scream cheap. But it also doesn't look expensive for a business that's moved past its capex peak. And that's where opportunity often hides, in quality, before consensus catches up. As investors, we often analyze dozens of numbers, ratios, and narratives. But the real magic happens when we bring it all together. That's why the final section of Pokarna's research report offers a 15-point investment framework, a clean, complete summary to answer one question. Should we seriously consider Pokarna as a long-term investment? Let's walk through this framework, exactly as presented in the report. Business quality. 1. Focused B2, B model. OEM-led exports in quartz, captive granite supply, low complexity, focused execution. 2. Strong moat, only Indian firm with Bretonstone license, high entry barriers due to tech plus capex intensity. 3. Margin quality, consistent gross and EBITDA margins, lean cost structure from automation. 4. Return ratios, ROCE greater than 20%, ROE greater than 25% in FY25, high capital efficiency post-capex. Governance and management. 5. Promoter holding and skin in the game. Promoters hold 56.7%, no pledging or dilution. 6. Capital allocation, clean track record, no reckless M&A, paid off debt from internal cash flows. 7. Transparency and audits, audited by Deloitte, no red flags, clean books. Financial strength. 8. Free cash flow generation, positive FCF post FY22, capex cycle behind, cash compounding ahead. 9. Balance sheet quality. Debt reduced from 515 crores to 330 crores, 123 crores in cash reserves, FY25. 10. Working capital efficiency, CCCC improved from 85 days to 18 days, healthy receivable and inventory turnover. Growth and valuation. 11. Revenue visibility, export demand recovering, capacity still has headroom. 12. Operating leverage, quartz plant automated, margins expand as volume grows. 13. Valuation comfort, PE at 18.1x, near historical average, supported by cash flows and ROCE. Risk review. 14. US market dependence, high export concentration risk, customer dependency flagged. 15. No consumer brand. OM model equals no pricing control. Brand value sits with buyer, not Pokarna. Out of 15 points, Pokarna checks 12 solid green boxes with 3 key risks called out transparently in the report. That's not hype. That's conviction backed by research. Pokarna may not be flashy, but it's efficient, focused, executing. And that makes it more than just investable. It makes it a compounding machine in motion. In this final analytical scene, we bring together all the key success and risk variables that shape Pokarna's future. 1. Business model quality. Does Pokarna operate with simplicity, focus and durability? Rating, strong. Why? Focused on quartz exports plus captive granite. 2. Moat strength. Does Pokarna have defensible advantages? Rating, strong. Why? Only Indian firm with Bretonstone tech license. 3. Operating leverage. Is Pokarna benefiting from scale? Rating, strong. Why? Quartz capacity scaled up, now hitting utilization curve. 4. Capital efficiency. Is capital being used intelligently? Rating, strong. Why? ROCE crossed 23%, ROE at 27% plus. Fixed asset turnover improved from 0.81x to 1.27x, no equity dilution, CAPEX self-funded via internal cash. Verdict, high-quality compounding metrics. 5. Governance and promoter alignment. Is management credible and investor-aligned? Rating, strong. Why? Promoter holding at 56.7%, no pledging. Stable dividend policy, 1.86 crores per year. No audit flags. Deloitte certified books. Institutional shareholding increasing. Verdict, clean track record, skin in the game. 6. Risk factors. What could go wrong? Rating, medium. Risks mentioned, high dependency on US market, OEM model, no consumer brand, limited pricing power, customer concentration, a few large buyers. Verdict, transparent risks, but manageable if execution remains consistent. Pokarna's key factor scorecard is clear. 5 out of 6 factors rated strong, 1 flagged as medium risk, with detailed explanation. It's rare to see this level of consistency across business model, capital use and governance. No company is risk-free. But this one, it's already built the plant. It's already proven the margins. Now it's just executing. Pokarna, strong where it counts. Disclaimer. This content is for educational and informational purposes only. It is not investment advice, nor a recommendation to buy or sell any security. All financial data and insights have been sourced directly from the official research report. Please consult a registered financial advisor before making any investment decisions. If you found this breakdown helpful, here's what to do next. Like the video, subscribe for more deep dive, research-backed investor stories, drop a comment. Which stock should we decode next? And remember, clarity builds conviction, conviction builds wealth.